Thank you guys for attending this morning. Thank you for coming out here today. We appreciate it. I appreciate it. So thank you. My contribution today is on the investor experience, specifically the balanced investor experience. And perhaps you guessed that already by the quintessential 60-40 portfolio on the screen in front of you. Now, not everybody's got a mix of 60% stocks, 40% bonds, but chances are, if you're in the audience, you got a mix somewhere around 60-40. You know, it's actually very easy to build the balanced account that you see in front of you. That's the easy part. The hard part is maintaining that balance through the inevitable ups and downs of a market. I do this for a living, and I'll be the first to say that's the hard part. It really is. One of my favorite quotes on balance and asset allocation actually comes from Bob Landaas. And if you've been a client of the firm for many years, or you've been to our seminars in the past, you guys are going to know this one well. Bob actually takes his quote from the body of work of Dr. Harry Markowitz, who's the father of modern portfolio theory. He is to whom which we owe that 60-40 portfolio on the screen in front of you. Well, the quote goes a little something like this. It's the mix of stocks and bonds that drives more than 90% of your long-term returns and risk reduction relative to anything else. It's the reason why we obsess over the mix of stocks and bonds, because you get this right, essentially you get 90% of everything right, and well, everything else just falls into place. So what I thought we would do today is to go through a little exercise, all of us together. Let's review this account in front of you. And I'll begin. I'll start with where I always start the process. That's going through the mix of stocks and bonds. That blue pie piece is domestic stocks. The red pie piece is non-U.S. stocks. The orange pie piece is bonds. And 2 is that green sliver, which gets classified as cash. A lot of what our system classifies as cash really is just short-term bonds. It comes due in the next few months, but it behaves like cash. Really part of the bond allocation. Big picture, 60% stocks, 40% bonds, and I'll say all of that differently. You got 40% of your money in high-quality short-term safeguards. It means that you got plenty to navigate the volatility that we've been going through. But still, 60% in stocks, so plenty of room for long-term growth. And historically, those two things together, stocks and bonds, it lends itself well to better returns for less risk over time, for as long as you've had patience. By the way, patience is going to be an important word. We'll come back to that, I promise. But it doesn't always feel like we've gotten better returns for less risk, does it? It doesn't always feel that way. So part of what I have to accomplish today is I have to put into context and perspective on where we are as balanced investors. But the only way that I can do that is I just have to go back and to show you, here's where we've been, to understand here's where we are and ultimately where we're going. So, let me take you through a trip down memory lane. All right, take a look at the graph at the bottom of the screen here. This is a 5-year look back on this 60-40 portfolio. It goes back 5 years ago to this point, 2019. Back then, stock market was doing pretty good. The economy was doing okay. It was fine. We actually had a temporary peak in the market in 2019. Only for us to turn the calendar to 2020. COVID hit. The world was shut. 15% unemployment. Tens of millions of Americans without a job. The economy was in a free fall throughout all of 2020. Even though the economy was in a free fall, the market actually started to recover that year. Then in 21, the United States reopened for business. So too did the rest of the world. And after a year being stuck at home, all of that pent-up demand, do we go back to being consumers, didn't we? We went back to restaurants and bars and movie theaters, did home renovation projects, got on cruise ships, you name it, we did it all in 21. Well, it meant that the economy came back with so much strength and vigor that year, pushed up inflation to 9% and the Federal Reserve got scared. Market peaked, essentially December 31st of 21. Yeah, it's a bummer that the all-time high coincides with year end, but it's what we have. Then in 22, the Federal Reserve aggressively raised rates 7 times that year with the sole purpose of cooling off an overheating economy. Well, they got their way, but they pushed us into a bear market and we bottomed at the end of the year. As you can see, we've rallied substantially since. So here's the point. In 5 years, you have endured a pandemic, a recession, 9% inflation, and a bear market. You've gone through 4 significant economic events in succession. If you had patience, take a look at that graph one more time. You are meaningfully higher today than you were just a few short years ago. Not too bad. You know, after making 24% last year in the S&P, high single digits in your bonds, we're up another 20%, give or take, this year in the S&P 500. After making so much, so fast, I think it just naturally begs the question, you know, what do we expect out of this balanced strategy? What should we expect out of the 60-40 account? So here's what we are expecting. There's still room to run in stocks and bonds. They can grind higher, but we're not going to move at the sprinter-like pace that we've set. You're going to have to expect something more modest, something more normal, and expect volatility to continue. It will be bumpy. Just know that volatility is normal. It's expected. It's okay. I don't like volatility any more than you do. I just realize that it has a purpose. The reason why you get paid so handsomely to own stocks is to put up with all of the volatility. So, what's going to take us higher from here? Well, it's the fundamentals, of course. Interest rates and earnings. These are the only 2 things that the market genuinely cares about long term. So here's where we are with both. We'll do interest rates first. As you heard Kyle mention, the 10-year Treasury is about 4%. That represents historically low borrowing costs for people and for businesses, and that's good. Corporate earnings. We're now in the 4th quarter, so we have a very good handle on what businesses have made. But more importantly, what are they going to make for all of this year? Earnings growth expectations for this year are still 10 to 12% above what was a pretty good year last year. We're already looking ahead to next year. Earnings growth expectations for next year could be as high as 15% above a very good year this year. So for now, today's environment for the balanced investor, you guys, today's environment is one of historically low interest rates, cooling inflation, rising profitability. Still some room to run in stocks and bonds, but you got to expect something more modest and expect volatility to continue. All right, so this is my last slide for you. Just trying to keep things simple. What I really need to do here is I need to hammer home the point that balance is the most powerful tool in your toolkit to meet your goals and objectives in your financial life. That balance is the most powerful tool in your toolkit to navigate the markets ahead, because the markets ahead are uncertain. Well, that's always the case, isn't it? Right? Balance remains the best antidote to uncertainty. Well, this graph says all that and a whole lot more. Let's go through it. This one goes back to 1950. You have 74 years worth of history in front of you. And it shows you the range of returns, the range of variance that stocks have traded in, that's the black bars, or that bonds have traded in, that's the gold bars, or that 60-40 portfolio we've been talking about. Well, that's the green bars. And you can see that in any 1 year period of time, my goodness, the range of returns, the range of variance for stocks, it's enormous. It can range anywhere between, this is the most amazing year ever, to this is the worst year ever. Or somewhere in the middle. Where it gets interesting is when you blend together both stocks and bonds. Well, my goodness, that range of returns, the range of variance really tightens up in a hurry, doesn't it? More interesting still is when you start to extrapolate that balance out over meaningful periods of time. 5 years, 10 years, 20 years. Take a look at the returns on that 60-40 portfolio 20 years on. My goodness, the returns on that balanced account are nearly as good as having 100% of your money in stocks. But you've gotten those returns for a fraction of the risk, fraction of the headaches, fraction of the ups and downs. You've gotten stock market-like returns without stock market-like risk. That's an important point to make, don't you think? And for most people, that's the crescendo. Stock market-like returns without stock market-like risk is an important point to make, but it's not the only point to make. There's something else here. Let me show you. Take a look once more at that 60-40 portfolio. Since 1950, there has not been a single rolling 5, 10, or 20-year period where the patient, balanced investor lost money. I'll say that again so it can sink in. In the last 74 years, for the patient, balanced investor, there has not been a single rolling 5, 10, or 20-year period where you would have lost money. Not one. And that right there, well, that's the essence of why you hired us, isn't it? To make money when it's easy to make money, and don't blow it when times get tough. Well, the only way that you can do that successfully and reliably is through balance, because you know what? Times do get tough. Bear markets happen, recessions happen, these things exist. We must be able to navigate our way through. The only chance you have of doing that successfully is adhering to balance, because when times do get tough, you got 40% or so in bonds to give you the courage and the confidence to hold on through tough times and not make a knee-jerk reaction. It's true, balance gives you courage and confidence, but it gives you something just a little bit more critical than that. It gives you patience. Patience. I told you we come back to this word. Patience, not only is it a virtue, it's a skill. And it happens to be a skill that the market rewards more than anything else. So my message to you on the investor experience, if you want this experience to be a good one, my message to you, have patience with the markets, have patience with the economy, have patience with your investments, because your patience will be rewarded. Thank you for your time.